the AI market grew to $152 billion from $111 billion. This industry is expected to see strong growth over the next decade across hardware, software, and services, and have huge repercussions on the rest of the economy. This makes it very important for investors and traders to understand this space properly and be able to position themselves for this trend. There are three main ways you can bet on AI. We're going to look at each one, understanding their potential, but also their risks and how traders can capitalize on them. One of these opportunities is still under the radar and may be significantly undervalued. Now, the most obvious bet on AI has been semiconductor stocks, NVIDIA being one of them, of course, but also stocks like AMD, Intel, Qualcomm, and Micron Technology. So far, these stocks have been the big beneficiaries of the AI boom, as they've been essentially selling shovels during the gold rush. They're producing the chips that power artificial intelligence. The earnings per share of semiconductor stocks have doubled from $80 in 2022 to $164 today as a result of this initial excitement. But this is a market that's projected to grow significantly over the next decade, with the chip market size potentially reaching $227 billion by 2032, a tenfold increase from today. This is what the semiconductor ETF SMH looks like. Since its low in October of 2022, SMH has surged by 200%, tripling in price. These stocks are in a technically very strong posture, staying consistently above key moving averages and clearly printing higher highs and higher lows. Unfortunately, nothing is perfect because these semiconductor stocks have become quite expensive. The average PE ratio of semiconductor stocks today is currently 33, which is significantly higher than the S&P 500's average PE of 20. So investors are paying a significant premium for each dollar earned by semiconductor stocks as opposed to the rest of the market. While this shows strong market confidence, it also poses a greater risk for these stocks if excitement around AI cools down, leading to lower valuations. That's going to depend on whether demand for AI chips remains strong. And that brings us to the next big major investment opportunity on AI. US mega-cap tech firms, large tech stocks like Microsoft, Google, and Amazon. These tech giants control the essential infrastructure required by AI startups like OpenAI. Microsoft, for example, has invested billions to become OpenAI's exclusive cloud provider, which entitles it to up to 49% of OpenAI's profits. This partnership ensures that Microsoft is deeply integrated into the AI ecosystem. Google announced its new AI chip processor named Axion a couple of weeks ago. This is following similar announcements by Amazon and Microsoft in the race to scale up in AI. In 2023, big tech invested over $25 billion into artificial intelligence. That's up from around $6 billion in 2022 and even lower levels in the years before. Their goal is to disrupt major industries like healthcare, media, finance, and education with this new technology. Just like semiconductors, these stocks have been performing very well. Microsoft is up over 100% since its low in October of 2022 and is also in a very clear and strong uptrend. We can say the same thing about Google or Alphabet, that has only recently managed to properly clear its 2021 all-time high. And we can also say the same thing about Amazon, which is up 120% since its low in December of 2022. But has yet to really clear its 2021 all-time high like Microsoft and Google. Similarly to semiconductors, these big tech stocks are quite expensive. Both Amazon and Microsoft have forward PE ratios above 30, which is considerably higher than the rest of the market. Google, on the other hand, has a PE ratio of 20, which makes it the cheapest bet on big tech AI. However, it would be a mistake to think that just because the valuations of these stocks are expensive, it's guaranteed that they're likely to go down in the short term. Stocks with high valuations can stay expensive and get even more expensive in the short term. There is an inverse relationship between PE ratios and returns, but only over the long run. So valuations is something that investors, not traders, should be paying more attention to. For long-term investors, there is a third, cheaper alternative to gain exposure to artificial intelligence, and that is utilities. Utilities are companies that provide essential services such as electricity, natural gas, and water to homes and businesses. Demand for electricity is projected to increase significantly as a result of AI. Between 2022 and 2026, the electricity consumption of global data centers is expected to double, reaching over 800 terawatt hours, the equivalent to the entire annual electricity consumption of Japan. This surge in energy demand could benefit utilities. These are stocks that have underperformed the S&P 500 by over 60% since 2009, and currently have a PE ratio that's much lower than the rest of the market. For now, this underperformance of utilities relative to the S&P 500 is showing no signs of stopping. But if these projections around electricity consumption over the next decade prove correct, it could benefit these utility stocks and finally get them to outperform the S&P 500 like they were, for example, between 2003 and 2007. This is how utilities have performed over the last 5 years. This is a chart for XLU, the most popular ETF for utilities that you'll easily be able to find on Capital.com. The performance of these stocks over the last 5 years isn't exactly impressive, but XLU has recently surged quite rapidly by over 30%, breaking out above the key downtrend that it's been in since its all-time high in August of 2022. This breakout, along with key moving averages beginning to curl upwards, could finally be a sign that utilities will garner more excitement from market participants than what we've seen over the last few years.